Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. So Nancy Davis, Chief Investment Officer of Quadratic Capital Management, maybe if you can give us a background to your history and your role in finance today and how you actually came to be the CIO of Quadratic.
So I founded Quadratic in 2013. Prior to starting my own firm, I spent the majority of my career at Goldman Sachs. I was there for about a decade, mostly on the proprietary trading group. So we had no clients. We just invested Goldman's capital. And it's a great opportunity. I guess prop desks don't really exist anymore, at least in most banks. And felt lucky to be there during that time. And see, I got promoted to be the head of credit, derivatives, and OTC trading for the whole team when I was in my mid-20s. So it was pretty awesome.
It would have been an interesting time to be on the prop desk of Goldman Sachs. It's one of the places where there's a lot of stories that come out. But I'm really curious around how you thought about risk at that period of time. You know, what did that teach you? Obviously, the prop desks aren't available like they used to be. What do you feel that you learnt about sort of managing risk and trading markets at that time?
Well, for me, it really taught me to use asymmetry and convexity in portfolios. Especially when Goldman was a partnership, a dollar that you lost was actually probably even more important than a dollar you made. So using options was really where what later became Quadratic was really created from the Goldman prop desk when we structured defined downside, but then asymmetric upside.
And when you were working, obviously trading options, how do you feel that market has changed, right? It was probably one of those areas that was much more institutionalized and high net worth. Now options, we keep thinking about them with regards to the Wall Street bet style crowd, retail people coming in. Options has been very much democratized. How much do you think that's changed the option market particularly?
So most investors, I think the one thing your question was, what has changed over the last, since the financial crisis in the options market? And I think the big change has been the rise of systematic strategies. And many systematic strategies are based on the back test. And the back test looks great when you sell optionality. And so I think a lot of the strategies have, I like to call them G-rated names, whether it's alternative risk premia or carry or all sorts of benign names for selling options. And that the world has kind of turned to as an alternative because we've had very, very low, if not negative yields for so long that people have been looking to these volatility selling strategies. So I think back in the 80s, the world was mostly dominated by people buying options and using options for hedging and protection. Now, I think the world is pretty dominated by people needing carry and leverage in their markets and using options to sell them to harvest that volatility premium.
Do you feel that the amount of leverage that's been added into the system has really made the markets actually much more unstable?
I think it's probably a combination of not very many market makers and also just the markets are definitely unstable in terms of liquidity. You could see that even in March 2020, the Treasury market was really, the US Treasury market was, I would say, almost broken. So I think it's just a sign that liquidity can go away in any market. I know a lot of CTA strategies sell themselves to investors as long volatility. I think that's garbage because it requires that you have liquidity to implement stop losses to replicate option-like payouts. So I think you have to be very, very careful with linear derivatives, so futures, forward swaps, because you are relying, to me, it's like credit card exposure where you get exposure to something and you don't really pay for it.
I found that piece really interesting around the liquidity challenges, and many of the super funds in Australia found similar problems in March 2020, just not being able to trade anything in the volumes that they need. How much do you see that as being a bit of a problem in the market, that the central bank is always seen as this backstop? We've cut out the prop desks. The market is really failing in many aspects to actually deliver what it's supposed to, which is this market mechanism to allow for a constant equilibrium or a balance.
Well, I think the big bubble has been many institutional investors have been going into private markets because they're not mark to market. So they have, on paper, less volatility, but I like to call those the three monkey strategies where, the monkey can't see, can't hear, and can't speak because the volatility is still there. It's just not price volatility because there is no mark to market. So I don't think investors should shy away from volatility. And I think a lot of investors have been trading off the liquidity premium by going into private markets because when you look at their mark to market, they look like they're lower vol, but I don't really think how would a private corporation be any different than a public corporation in terms of, their costs, their expenses, profit, earnings, what business they're in. It's just kind of the same thing. It's just the liquidity premium has really gone away because so many institutional investors are funneling into private credit, direct lending strategies. It's just become wildly popular.
It's a really interesting time because you've got so much money flowing into these areas, and that's been obviously very beneficial because these are still new markets, particularly around private credit. It's been growing over a number of years and more money's come in, but pricing's become very tight on these assets. And we just haven't seen any major correction in the last few years. What happens when you don't have this liquidity, when you've got real demands for people to actually pull out? How does it, how does this now work in reverse?
I think it's going to mean that the public markets become the funding vehicle. And so it's going to mean more volatility for the overall markets, especially with some of these private funds where they can tap investors for liquidity when they need the capital, the drawdown funds. So I think what it means is just greater volatility in the public markets because that will be the only place where there is liquidity. Because if you have a fund with say a 5-10 year lockup, there's really no choice. And so I understand the appeal because many investors are very, very long term, but I think a lot of the portfolios have been sacrificing that liquidity premium and the private markets have become, in my opinion, quite expensive.
I find that really fascinating because I think for a lot of investors, they see the large end of town, some of these very big corporates in the equity pools, they're long-term investments that they want to hold, but ultimately they're almost de facto liquidity pools. And I'm not sure if the general market really understands that issue, and then the pressure that will come on that particular area. We have seen it anecdotally in last sort of crises where you see these real big sell down for no reason, and obviously it's a liquidity-related issue. But particularly in the case where we have so much passive investing in the markets today, how much do you potentially see this problem to be even amplified because you're selling these very large tech companies, for example, that are a very big part of your portfolio, and then it's just driving down passive indices as well?
I think it just means that the volatility is generally probably not priced correctly because there's so much search for yield as well as so much reliance on portfolios being non-correlated. Most investors have something that looks like, a 60-40 portfolio with some alternatives sprinkled around. But if everybody has, I think especially stagflation is a huge risk for a 60-40 portfolio. And I don't know about you, Alex, but I feel it every day that we're having higher prices in the market, but not necessarily growth. And it's really as a result of the pandemic and the supply shocks around the world. So I think investors really need to be thinking about what's going to happen going forward and how they can protect against stagflation or increase in volatility, or even if we have inflation, that's another way that investors can lose their money across the portfolio all at the same time is inflation. So I feel like there's a lot of focus on asset allocation and diversification, but not a lot of attention on the stagflation inflation side. Vol.
Oh no, vol is what I wanted to come back to, right? And you mentioned that the volatility is not priced correctly. How much do you feel that that's a part of really the central banks suppressing volatility through their processes?
Well, I think equity volatility is priced correctly, just to be fair. I think anyone can really access the equity or index options markets. It's very easy, and many institutional investors use that market. So I don't think there's a mispricing in equity volatility. I think the mispricing is actually fixed income volatility, specifically interest rate volatility, and even further US interest rate volatility, with the combination of fiscal spending, a blue wave politically in the United States, and the Fed, being really, really focused on employment. I think it's a really important time, whether we have inflation, deflation, or stagflation. I think fixed income volatility is the thing that looks most interesting to me.
It's fascinating when you look at the market coming out of COVID, and there has been so much stimulus from a fiscal policy point of view, and yet people still feel that the inflation is containable. Maybe not everyone, but the central banks definitely feel that that's the case. How do you then sort of think about it through your mind?
Yeah, I'm not sure if we're going to have inflation or if we're not. It's unclear to me. I do think the biggest risk for investors is actually a stagflationary environment, which would be when stocks and bonds sell off together. And whether you're a private company with debt or a private public company, it doesn't really matter, because that's bad for growth and bad for earnings. So I think stagflation to me is the biggest risk that I see. And I don't think a lot of people are talking about it. But to me, it looks like the same thing that we had. The US had stagflation last in the 70s. And it was a result of the oil embargo. Today, it's just a different underlier. It's a chip crisis globally that we're having, and chips go into everything from cars, phones, appliances. What are chips not in? And I think that chip crisis is, to me, very similar to what we saw in the 70s. And I think investors really have to be thinking about how they protect their portfolio if stock and bond correlations actually become positive, and that stocks sell off with bonds. What are they going to do? And I think that's where fixed income volatility really comes into play.
I can't not talk about really the corollary to the 1970s, which is around the oil embargoes and the price rises that came from that. We've got a similar problem today, and that is ESG, particularly around some of the carbon neutral, carbon net zero approaches that people are looking at, that is really trying to put more and more pressure on these oil companies, which may create this de facto inflation in that way. How much do you see that as a bit of a problem?
I mean, I think everybody is very well intentioned, but I do have a big problem with the ESG industry. Generally not about their focus on carbon, but it just seems, I manage the IVOL ETF, which is a fixed income inflation fund that's also long US interest rate volatility. And I know I find it very frustrating because a lot of the ESG rating agencies, they don't rate us as a ESG ETF because they are focused so much on passive indices or indices that have ESG in the name. And I find it a little frustrating because I think there's a lot of greenwashing that goes on in the industry, and there's a lot of capital that's being allocated to and there's a lot of pressure on certain sectors, as you talked about with the energy companies, that could be wildly inflationary. And I think IVOL is an access fund where we give access to the OTC rates markets. And from a governance point of view, it is a registered minority small business enterprise, Quadratic is, and also a majority woman-owned firm. So I think it's very unfair that some of these rating agencies would give so much preferential treatment to public corporates, with their stock and bonds because of their governance with their boards. Whereas we, as a woman-owned, minority-owned firm, are not ESG because we don't meet their screening criteria in stocks because we're not a stock fund.
It's fascinating. I think it's a really politically charged space, the ESG space at the moment, and there's a lot of money being thrown around, both from a marketing point of view, from branding and getting the various labels from different organizations and tick the box approaches. It's really quite fascinating because there's a lot of talk about caring for the environment and what we need to do to actually help the environment, and we can do that through supposedly moving financial assets around most of the time. So it really seems quite an interesting debate or academic debate around what actually impact do people have allocating to these ESG wrapper style products.
IVOL is so important in that ESG mix, because if we have all this allocation, as you pointed out, to pressure on, other energy companies, it could actually be inflationary. So why would you want to have all your chips on one asset class? It seems like adding fixed income volatility and inflation expectations is so important, but it's hard when you're kind of fighting. The ESG is just like, it's kind of feels like the wild, wild west, where it hasn't really been defined. And it's very easy to run quantitative models that screen public data like what corporations put out. But I just don't think only looking at, stocks and corporates is the way to go.
Well, I guess where I wanted to get to also around this was that there's a fiduciary duty to protect your members' capital, and a fiduciary duty around earning returns and trying to allocate to the best place. And so to that end, that's where I think your product and the idea of being very cognizant of the inflation risks is critical. And I'm not sure how that aligns with the ESG crowd. I think there's a very clear governance perspective that needs to be thought of, and there's still very much a fiduciary duty umbrella that needs to go over all these products. The other thing that I wanted to touch on, for you today, you've mentioned a couple of times around the increasing level of fixed income volatility that's coming in. How do you expect that to turn up? Are you expecting a steepening in the yield curve? Are you expecting changes through the yield curve? Are you expecting parts of some of the more corporate credit areas to pick up and create some more volatility? Where do you see the change coming?
Well, I think when you look at inflation assets in the United States, at least commodities are quite high. Many currencies that are commodity centric also have appreciated a lot. And then you look at the equity markets, where many of the equities that are sensitive to inflation have increased tremendously. And I think the one real pocket of value in the inflation markets are actually interest rate volatility, because inflation is one of those things that doesn't have a zero bound. It can go negative. So using options to access the inflation markets makes so much sense to me, because then you have, at least with the options piece, that defined downside in case there is, a deflationary pulse or things turn the other way, because inflation is a very long-term, slow-moving process. And I also think that many investors are very focused on one index in terms of how they measure inflation. And to me, that just seems very silly. It's like if the global economy says, all right, we're going to use the Aussie index, and that's equities for the world. It's just one index, right? And many investors in the US inflation markets are very focused on break-even levels, which are set by the consumer price index. And the key word is index. It's just one index. It's set by the Bureau of Labor Statistics. It doesn't mean that it's wrong, but it might not be relevant. And that's why we actually have a lot of Aussie investors in the IVOL ETF, and they use it as a way of accessing 85% of our fund is treasuries with inflation protection, so the TIPS market. But then we access another measure of inflation and inflation expectations in the rates market, which gives, I think, a broader and more market-based measure of where inflation is, because so much of the CPI index is rent. About 30% is, shelter, and shelter is owner-occupied rent in that calculation.
I'm really curious around the makeup of the portfolio. You mentioned that it's got a very heavy amount of tips in there. I'm curious as to why that's the case, as opposed to, for a lot of institutional investors, their ability to get access to tips is quite easy. Why aren't you just managing a portfolio of OTC options?
So we rebate the acquired fund fee that we use for the tips. So the tips are actually no cost to investors. We do that to be very tax efficient. So we had funds, 40 Act funds in the US are taxed as an entity. So at least for 2020, we had zero capital gains tax on the fund level. And so the investors aren't actually paying us to manage the TIPS portfolio. What they're paying for is our expertise in managing its actively managed OTC interest rate options. And so it's an access product. And we have lots of professional investors, macro funds, emerging market funds, structured credit managers, many investors who use the iVol ETF who are professional investors to gain access to the OTC rates market. And I think it's even more important with the time zone differences, like who wants to be managing a long gamma portfolio when they're, 16-hour difference in time. So.
No, I totally understand that premise. I was sort of thinking more so in terms of like, where does this sit for an institutional investor? They've got very particular buckets to where they put things. Does this then sit specifically in their fixed income style bucket, or is this sitting almost in their alternative bucket because it has so much optionality attached to it?
It typically sits in their fixed income bucket because the fund is 85% bonds. It's U.S. Treasuries. So most investors put it in some people use it in a crisis risk offset bucket, which is where they put strategies. I've always long fixed income volatility. It's also long U.S. government bond duration. And it's also long the exposure to another measure of inflation expectations. So I see most people just using it in their fixed income portfolio, but we do have some investors who put it in the alts bucket. They tend to be, we have a few fund to funds who use the ETF. And other investors, we have one in South Africa and another in Switzerland that I know about.
I'm curious also around the ETF wrapper. It seems unusual for, I'd say, most institutional investors to want to participate in an ETF wrapper. Can you give a bit more context on why you chose that approach?
It's very low cost for our institutional investors. And I think, as we talked about before, many investors have moved into the private space. And so there's having that liquidity buffer, especially when you have a long volatility strategy, I think is really attractive to institutional investors, because if they have a funding need, say, they have to find a private equity or a venture deal, they have the liquidity whenever they need it to take the cash out. And so I think giving investors a liquid, low cost, it's long duration, long convexity, long gamma, long volatility, and also long liquidity at a very, very low fee is something that's been very attractive, especially in the Aussie community.
Mm-hmm. I'm curious around why you don't have any optionality, for example, on something like gold or some of the commodities, which have also been seen as a clear hedge for inflation.
I mean, we put out a note, I think it was third quarter of last year, about gold as an inflation hedge. It was more, I personally don't think gold is a great inflation hedge because it doesn't have any kind of carry. It doesn't pay a distribution. In fact, you could probably argue that there is a carry cost to it, at least with physical gold, because you have to put it someplace and store it and guard it. I think Warren Buffett actually said that, in the late 90s, I believe, that people, Martians looking at the Earth would think we were out of our mind to dig it up in one hole, melt it down, and stick it in another hole and pay people to guard it. So iVol pays out a very high monthly distribution of 30 basis points a month, or about 3.6% annualized in distribution. Many investors find that attractive because gold is especially if you own gold in Aussie dollar or gold in US dollar, it's actually a negative carry asset because you have to fund it in the local currency. So I think gold's a lot of things. I think it's a currency trade. I think it is a psychology trade. But I do think gold has its own beta, and it's not a great inflation hedge. Because think about it, if we had inflation, we would likely have higher interest rates. Why would you want to have something that pays no dividend?
I think then the challenge becomes, as you think about how much inflation versus the interest rates moving, it seems to be, going back to your analogy to the three monkeys, there's the blind monkey around inflation, I think, to some degree, as to how much inflation there really is versus the underlying interest rates. And so to that end, can you potentially see some interest in gold, even in products such as the REITs, as another place where people can look to sort of hedge, where they see almost a disconnect between what's being reported as underlying inflation versus the reality of inflation, then versus the actual interest rates today?
I personally think gold's going to have a hard time as an inflation hedge. Gold is a lot of things to people, but I just don't think it's a very good inflation hedge personally. And that's because of the negative carry.
Well, let's take it back to your homeland, the US, and the state of the US economy today. It's obviously a key part of your thinking and the fund that you've created. How do you see sort of the US trading through the next sort of 3 to 5 years as it comes out of the backside of COVID? You've had obviously a change in government last year. There's been a lot of excitement about spending, although things have been pretty slow. So I'm just curious around how do you see sort of the economy transitioning post-COVID with the current administration and what do things look like?
I think the big challenge is getting the labor force mobilized in the US and getting people back to work. The unemployment rate is still pretty high, and everywhere you look, there are help wanted signs, and you actually are seeing wage inflation, which again, going back to my concern about stagflation, that could be really a disastrous outcome. I know we have many endowments who use the IVOL ETF as a potential stagflation hedge in their portfolio, because if we had higher labor costs, because people are preferring to collect their unemployment checks versus going and working in some of these industries, you could actually see higher prices, but not necessarily growth. So it's a really unknown time, because we do have this kind of wicked combination of tremendous amounts of fiscal spending, which are very well intentioned, but people also need to be good citizens and go back and get jobs. And right now it seems like a lot of people are, there are help wanted signs everywhere. It's very, very tight, the labor market, because people are not returning.
It's interesting that you say that, because then if I think about the potential other way that this could turn, is it becomes actually more deflationary. Once the tapering starts, the money starts to get pulled out. Obviously some of the inflation has come because of supply constraints and the market being locked up. Once supply starts to come on, people aren't buying, there is a clear potential that this could actually reverse and become quite deflationary. So I'm curious to get your thoughts on that potential risk.
I think that's one of the reasons I like IVOL a lot personally, because we can also do well with the strategy if we have lower front-dated yields. So since the option strategy, it's actually the options are agnostic to the level of interest rates. We would just want the spread between short and long-dated rates to widen. And we don't care if that happens because you have higher long-dated interest rates because there's inflation or stagflation, or lower front-dated interest rates, which would typically be an equity risk off when credit spreads are widening. There are a lot of hikes that have been priced into the front end of the US curve. So I personally am very excited about IVOL for that reason, because if we did have, a slowing of the economy, those Fed rate hikes that have been priced into the forward market will likely come out, and that could also steepen the curve.
All right. I think that's been a fantastic conversation. Thank you very much for your time today, Nancy.
Great to discuss with you, Alex.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.